Well, thank you and good afternoon and welcome to the DoubleLine webcast titled Smart Beta Trick or Treat. Our webcast will be presented by Jeff Mayberry today. A brief update on our last webcast of the year. So the next one will be up on November 8th with our international fixed income team covering various mutual funds here at DoubleLine. Then our Ken Shinoda, portfolio manager for the DoubleLine Income Fund, will be up on November 22nd. And to finish it off for 2022, Jeffrey Gunlock and portfolio manager Andrew Sue will be up covering the Total Return Bond Fund. We actually have the webcast schedule for 2023, so please go to doublelinefunds.com/webcast schedule. If you'd like to receive a copy of today's presentation slides, you can go to the webcast player and click on Request Webcast Content. You can also follow us on our Twitter handle, DLineFunds. Just to highlight DoubleLine's thought leadership in the media, we do have two YouTube channels, DoubleLine Capital and DoubleLine Funds. Here you can view the DoubleLine Channel 11 by Ken Shinoda. And then we have a new channel or series of content from our product specialists here at DoubleLine that will be posted on a monthly basis that will explore DoubleLine's latest thoughts on the financial markets, macro events, and drivers of returns in various segments of the market. We also have two podcasts, the widely acclaimed Sherman Show podcast with Jeffrey Sherman and Sam Lau, and then our very own Jeff Mayberry on the webcast today with Sam Lau with Monday Morning Minutes. Today we'll be covering two funds, the DoubleLine Shiller Enhanced CAPE and the DoubleLine Shiller Enhanced International CAPE. We also launched a similar version of the DoubleLine Shiller CAPE product in an ETF format, which if you were to view some of the content before the webcast, we went through some detail there. But here again, you can see the different expense ratio and minimums of those two open-ended mutual funds. The standardized performance on the DoubleLine Shiller Enhanced CAPE, ticker DSEEX. The fund was launched 10/31 of 2013, an 11.11% annualized return versus the S&P 500 at 10.44. So an outperformance annualized of 67 basis points. And the standardized performance on the DoubleLine Shiller Enhanced International CAPE, ticker symbol DSEUX, an annualized return of 3.67 since inception. We launched 12/23 of 2016 through the third quarter of this year. And that's versus the MSCI Euro net total return US dollar index at 2.73%. So a 94 basis points annualized outperformance. So with that, I'm going to turn the webcast over to Jeff Mayberry.
All right, thanks, Ron, and thanks everyone for joining us today. We did title this webcast "Smart Beta Trick or Treat," trying to take advantage of the fact that we are coming up here on Halloween next Monday, and that hopefully everyone's managed to not eat all of the candy they already bought for Halloween. I know that I've resisted buying candy so that I don't eat it myself, but I think just given the timeliness of it, I think that we can all agree that it's been some volatile times in the market, and whether smart beta, we think it's more of a treat than a trick. But let's go through kind of where we stand today in terms of a macro update. We'll do a very quick macro update, cover a few slides there, and then get into some details of the two funds here, both the Shiller Enhanced CAPE Fund and the Shiller Enhanced International CAPE Fund. Since we're only covering two funds today, we can do a little bit of a deeper dive into both of them than we have done in the past. If we look at where the U.S. economy is standing, one of the indicators that we like to look at is the New York Fed's weekly economic index. As its name suggests, it comes out weekly. That is the blue line on this chart here. You can see that it does tend to lead, or has in the past at least tended to lead the U.S. GDP numbers. And today, that the New York Fed weekly economic index shows a 1.7 year-over-year GDP. If we kind of look at where at the end of the second quarter, we had a 1.8 year-over-year GDP. The GDP now that the Atlanta Fed puts out, that's updated more regularly depending on when the data points come out. The Atlanta Fed updates that GDP number. And so they come up with their GDP now estimate of 2.9% for the third quarter. We do get the third quarter official GDP numbers, I believe, on Thursday of this week. But if we do get that 2.9 there from the GDP now, the third quarter year-over-year GDP will be 1.9%. So kind of very closely in line with this New York Fed weekly economic index of 1.7. So we'll continue to keep an eye on this, see where it goes. But again, we're looking at, not necessarily too bad of economic conditions these days, but also not the greatest conditions that we've seen. Another indicator that we do like to look at here is the year-over-year, the LEI, leading economic index, year-over-year numbers. And there's two lines here on this chart. The red one is the year-over-year numbers, and you can see that when that number goes negative, below that dashed line there, at least for the past 3 times, has led to a recession. Now you can look at 2006 and say, it did go below the dotted line or the dashed line, come back up, and then really showed that the recession was coming. But it's a pretty good indicator of, it gives you a pretty good lead, hence the name of the L in the leading economic index or leading economic indicator. And so, it's something, again, we look at. So this number broke below 0 a couple months ago. It's at negative 1.45 today. And so we're looking for maybe the possibility of a recession upcoming and maybe in 2023. I did see some news out recently that some economists predicted 100% chance of a recession. I think that, I would put nothing at 100% chance. And so I think that certainly there is we'll talk about it a little bit later, there is that chance for the Fed to engineer a soft or softish landing without actually going into recession. But let's look at the indicators here. The red one is showing that there's a decent chance of a recession in the next, call it 12 to 18 months. The blue line here is a 6-month change. And so what we do is we like to look at that because that will give you an early indication of when things are turning, when you get the cuspy data points where when the things are going to be on the upswing, maybe we're getting out of recession when that number shifts. But you can see that blue line is still continuing its downward trend. And so, since we're not in the middle of a recession right now, wouldn't expect that to be bouncing there off the bottom. This is a chart that everyone knows what's going on in the inflation data points today. Why is the Fed being so aggressive in their rate hikes? What has led to a lot of the turmoil in both the fixed income and the equity markets so far this year? And it's really on the back of these inflation numbers. You can kind of look at the orange line there, kind of in the middle. That's the Fed's preferred inflation gauge, the core PCE. That number has not come out yet. That number comes out on this Friday. But you look at all the other ways that the different Fed, the Atlanta Fed, the Dallas Fed, the Cleveland Fed, they all have different ways of slicing and dicing the CPI data, which is the CPI is the light blue. And in any way they slice and dice it, it all looks like the inflation is still on the uptrend, at least on the core side of things. If we were to put headline inflation on here, that number would look, we would have seen peak headline inflation. But the core numbers is really something that you're looking at and saying it's still pretty out of control. And really, this is why the Fed is continuing to raise interest rates and why they're continuing to talk up the idea that they're going to continue raising interest rates. And so, normally we would say that as the Fed's raised 300 basis points so far this year, maybe that would lead to they raise rates into a recession, causing the recession. Why is the Fed still continuing to talk about further rate hikes? And it's because of this chart right here. And this is a good indicator of why the Fed continues to want to raise interest rates. And if we look at the bottom, if we want to kind of put the labor market in a nutshell, we can look at this black line at the bottom. That's the job openings divided by the total number of unemployed workers. And Jay Powell has pointed this data point out earlier this year as wanting to get this down back closer to a 1.0 number. It is currently at 1.67. And you say, yeah, it's down from 2 to 1.67, is trending in the right direction. It was around that 1.7 number when Jay Powell did say that it was too tight of a labor market. So really what we want to see, or what the Fed wants to see, is this number come down. They would probably prefer it to be on the job openings front as opposed to the unemployed front. They do forecast a rise in unemployment over the next year or so. But really, they want to get this market more in balance, and they'll feel much more comfortable about where inflation is if this number became down closer to 1. Doesn't necessarily have to get to 1. Could be at that 1.2 range that we were pre-pandemic. but really want to get this number down. And this is why the Fed is continuing to raise interest rates and why they still feel comfortable raising interest rates, because this ratio is still high. And given that the Fed has raised interest rates so much, let's take a look at how this has affected the bond market. And normally we show these charts. We show the last 5 years. I was talking to Jason earlier today. I was like, let's look at what's the last 10 years look like. The last 5 years, it looks like the rates are all off the charts. And so we extended that out to 10 years, and the rates still look like they're all off the charts. Look at that 2-year, 461 was its high. It's at 4.5 today or last night. Just a year ago is at 40 basis points. So it's a pretty significant increase, or to say the least, in terms of rate movements there on the shorter end of the curve, whether it is the 2-year or the 5-year. The 10-year, it's at 424 at its high over the past 10 years, and then the long bond's at 438. Now, what did the longer end of the Treasury curve tell you? Certainly, the shorter end is moving with the Fed rhetoric, with the Fed raising interest rates. The long end is still, because that long end is rising, it hasn't really fallen. It's been almost a monotonically increasing line there. There was a couple of rallies there in mid of this year, I guess in the summer of this year. But really, the market is pricing in the fact that the economy is going to continue to stay strong. They're not pricing in a recession. You haven't seen that rally in rates that you need to get kind of that recessionary signal. So whether the 10-year or the long bond believes that the Fed is going to engineer that soft or softish landing, the market still continues to believe. You have seen that it does. These rates do kind of move in lockstep, though. You're not going to get a hugely, or you don't typically get a hugely inverted curve, whether you're looking at 2s, 10s. Usually it stays in that 50 or has been staying in that kind of 50 to 75 basis point negative range. If we're at 450 today on the 2-year, 424 on the 10-year, that's a negative 26 basis point rate. So it has been swinging around, but it doesn't look like you're getting a rally there on the long end of the curve. But given this huge rate move across the curve, there's nowhere to hide in the fixed income market. How's that affected fixed income returns overall? We'll look at the Bloomberg U.S. Aggregate Index. The black line is the year to date today, or this year 2022. You can see that is certainly the worst performer ever since 1977, when I guess it was the Lehman Ag back then was created. And you can see, the worst year before that was 1994. And looking back, that 1994 return was about a negative 3% or so in terms of total return for the year. So we would need today the Ag is down 16, or last night the Ag is down 16.8%. So we would need about a 200 or so, or over 200 basis point rally across the curve in the next month and a half, or I guess 2 months for the bond market not to have the worst year ever. Doesn't seem very likely. Certainly is possible, but doesn't seem very likely. So we're likely to end the year with the worst performing bond market overall. And if we break down, the Barclays or the Bloomberg Ag is treasuries, agency mortgages, and investment grade corporate bonds. If we break out to different sectors of the bond market, there's still nowhere to hide. Looking now here on the far right, you can see the yellow bar is the aggregate index. The dark blue in the middle is the emerging markets. So those are worse than the ag. You have your corporate credit, your investment grade, and your high yield, where your investment grade is down even more than the ag, down to almost 21%. You're kind of government guaranteed, whether it's in agencies or treasury space, also down 15 or so percent. High yield, you would expect that maybe with this talk of recession, the high yield would actually be doing worse than investment grade, but the duration on the investment grade side of things has really driven down those prices, driven down those returns. If we move into even leveraged loans, so something that you would go into the year, you say the Fed's going to raise 300 basis points. They got another 125 basis points coming the rest of the year. So the market's going to raise the Fed's going to raise 425 basis points on the year. You would want to be in the floating rate space, certainly. But even if you were in the best of the leveraged loan space, you earn double Bs, you earn a positive 50 basis points year to date. But anywhere else in the single Bs or triple Cs, we've got a triple C return negative 12%. Overall, if you just said, I want to get in floating rate and get in leveraged loans, you're down almost 3%. Move into the securitized space, maybe it's a little bit better. Some of the ABS is down, CMBS is down. Those have much more duration. Your AAA rated CLOs, that's down 1.1%. So that would have been another one where you would have gone into it and said, I want floating rate. I want to stay safe in credit. We're going to buy the AAA rated CLOs. You're still down 1%. And then kind of call out the legacy non-agency mortgage market, down 1.4%. So that's kind of your best performer out of the non-floating rate, certainly out of the fixed rate. The paper, that legacy non-agency RMBS space has been a good performer. But overall, nowhere to hide. But we'll talk about that. That leads to a little bit more opportunity. But that's all backwards looking, right? So that's what has happened so far this year. Here, let's look at this is from the WERP function from Bloomberg. What's the Fed funds implied policy rate going to be going forward? This is forward looking, but this is also what's priced into the market. So here you see the Fed is meeting next week, a week from tomorrow is when they'll have the FOMC meeting, and the market is pricing in a 3.86% implied policy rate. Today, the effective rate is 3.08, so it's pricing in just a little bit over a 75 basis point rate increase coming next week. And then you can see we go to 4.46 in December, so we got a slightly over 50 basis point implied policy rate there. So and then in February of next year we get a 4.82, so it's like a little bit over 25 basis point. So if we call it Fed's going to raise 75 in November, 50 in December, 25 in February. We have another 150 basis points of rate hikes coming. But then you can see it tails off. You don't really get, there's maybe a half of a rate hike, half of a 25 basis point rate hike there in May. We get to a 4.95 kind of peak Fed funds rate. Then the market's pricing in some Fed rate cuts, or they're pricing in the probability. So the market's not really saying, oh, the Fed's going to cut rates a little bit each month. They're not going to say that the Fed's going to cut 50 basis points or 50 basis points before the end of the year. They're just pricing in some probability that the Fed pivots, that the market turns weaker, and that really that's where we're going to go. So given this outlook, given that this is what's priced into the market, we're starting to think that we feel that the fixed income market is looking pretty attractive. Today, you have the Bloomberg Ag. It yields around it yields over 5%. It's it doesn't have that kind of 7-year duration that it used to have. It has a 6-year duration now. So that yield to duration ratio is looking much better than it has in the recent past. And getting that 5 to 15 type yield is something that overall in the fixed income market is looking pretty good. Now, both the Shiller Enhanced CAPE Fund and the Shiller Enhanced International CAPE, we're not buying the ag underneath it. We're buying shorter duration. We'll get into that fixed income portfolio. But overall, when people are thinking about fixed income, this is kind of where we stand. If we move into, let's kind of shift gears a little bit, move into the equity market side of things, and talk about the DoubleLine Shiller Enhanced CAPE. Those of you that have been around, this fund has been around. We're almost on its 9-year anniversary here. But let's look at the structure of it. So, this is a similar chart, similar flow chart than what we've produced in the past. We just enhanced the colors and made it look a little bit cleaner here. So on the right-hand side, or in the middle, you have the dark blue box. That's the DoubleLine Shiller Enhanced CAPE. So that's the fund. That's D6 in a box. When we get $100 or a $1, in case of if you look at the bullet points, we get that money. We invest it 100% of that into the notional swap exposure of the Shiller Barclays CAPE U.S. Sector Index. The investor at the end of the day receives 100% of that index return. Because we do it in swap space, we still have that dollar or $100 to invest in an actively managed fixed income portfolio. The investor receives that fixed income portfolio also. This is what we call the double value proposition, where you're getting both the fixed income side of things and the equity side of things. So let's focus on the equity side of things first, then we'll move into the fixed income side and then kind of pull it all together. So let's look at the CAPE ratio of the U.S. equity market. You can see that it's well off its highs. For the past few years, every time we've been doing one of these webcasts, we've been talking about how the CAPE ratio is very high. That doesn't mean you want to use it as a timing signal to say, I don't want to be in the stock market. It just means that your future looking or forward expected returns are going to be much lower given a higher CAPE ratio. So as of September 30th, the CAPE ratio has fallen down to 26.45, as you can see on the screen. Also, if you look at the legend there, you can see the average over this time period, over the past 40 plus years, is 24.3. So we're getting pretty close to the average CAPE ratio over time. And when you look at that, you can say that your forward expected returns should be much higher today than they were when your CAPE ratio was up at 40. It's not to say that we're not calling the bottom of the market. We don't think that this is really indicative of of trying to chime in or out of the market. It's just saying your expected returns on a forward-looking basis should be higher. And the CAPE ratio being a good valuation tool, one of the things that we do, and one of the things that this index does, is use the CAPE ratio to evaluate the richness or cheapness of the individual sectors of the S&P 500. So you can calculate the CAPE ratio on an index or a sector, which is just kind of is essentially like an index, or on an individual security. So what we do here is we calculate the CAPE ratio on a sector basis. And if you were to do that across the 11 sectors of the S&P 500, and you just chose 2 sectors, and certainly choosing these 2 sectors are done to illustrate a point. But if you just chose utilities and technology and used the CAPE ratio as your valuation metric and only invested in those 2 sectors, those are the only 2 sectors in your universe, you would look at that and say, well, utilities always has a cheaper CAPE ratio than technology, so we should always just buy utilities and never buy technology. That doesn't really make sense. It doesn't make sense to use that as a valuation ratio. Certainly utilities over time will have a lower CAPE ratio, a lower price to earnings ratio, whatever sort of valuation metric you want to be or what you want to use, utilities would use that or would be lower than tech. And so what Professor Shiller, who is well known for kind of inventing the CAPE ratio, or at least putting it out in an academic paper, what they did together with Barclays is to use what they coined the relative CAPE ratio. And so knowing that utilities will trade at a lower price to earnings than technology, let's normalize them together. Let's normalize technology, let's normalize utilities, let's normalize the other 9 sectors of the S&P 500 and compare it to itself. So when the current CAPE ratio is higher than higher than its current or the current CAPE ratio is higher than its average, then you would have a relative CAPE ratio of greater than 1. And if it's lower than its average, you would have a CAPE ratio of below 1. And so you can see that kind of normalizing those 2 sectors on the right-hand side, that chart will show you that there'll be times when technology is cheap and makes sense to invest in technology. There are times when in this simple sample experience that the technology would be rich and you would be investing in utilities. So this kind of normalizes things together. And so taking that basis, let's put that together into the Shiller-Barkley CAPE U.S. Sector Index Sector Selection Rules. So how does this index work? Every month, the Barclays calculates the CAPE ratio for all 11 sectors of the S&P 500. They compare it to its 20-year history, so you have 30 years of data rolling into this relative CAPE ratio. So they calculate the relative CAPE ratio, select the 5 most undervalued sectors or the 5 cheapest sectors based on the relative CAPE ratio. So the 5 sectors with the lowest absolute relative CAPE ratio. Now, sometimes there's a what's called a value trap, or trying to catch a falling knife. There's a rationale, or there's a sector that's cheap and it's cheap for a reason. So you kind of want to remove that sector. And so it's out of those 5 though. So calculate the worst momentum, 12-month momentum out of those 5 sectors. Kick that one sector out that has the worst momentum. You're left with 4 sectors. Equally weight those 4 sectors and do that every month. So the CAPE index, I'll just call it the CAPE index for short. The CAPE index does this process every single month where you're choosing the 4 sectors. If there are no changes in the sectors, you'll just rebalance to that 25% in each sector. And if there is a sector that is removed and a new sector added, you'll rebalance to 25% in each of those 4 new sectors. And then on the right-hand side here, you can see the 11 sectors of the S&P 500. So it's a pretty simple process. One of the ideas that we liked about it was that it is simple. We can explain it. The weightings are 25% in each sector. That's something that is a very academic approach to things. They're not trying to game the system by changing the weights. They're really saying 25% in each sector. Let's do that, and let's do that every month. And we do it at the beginning of the month, so there's no trying to time different markets. It's really just doing it at the beginning of the month and invest for that rest of that month in those 4 sectors. And now if we look at the relative CAPE ratio here, this is through September of this year. A couple of things stand out at this chart. Certainly, energy is the first thing your eye goes to. Energy was cheap for so long, and then we had to expand the axis on this chart a few times to kind of incorporate how high energy got. And it's come down a little bit now. Still off the charts cheap. or off the charts rich, sorry. Off the charts rich, way high relative CAPE ratio. Certainly doesn't look like it's going to be in the CAPE index anytime soon. The other thing that points out is the opposite side of things, and that's communication services. That's that dark blue line at the bottom of the chart. And you can see how bad that momentum has been in communication services. And it's been one of the cheapest sectors for a while now, for the past couple of years. But really, it's been that momentum has been so poor that it's been kicked out due to that value trap filter. So if you look at this, and we have these, helpfully, we have the legends lined up in terms of their relative CAPE ratio. So if we know that communication services is kicked out due to momentum, we have financials, real estate, technology, and consumer discretionary as the four remaining sectors that are cheapest. And so for September, we would have started the month equally weighted in each of these sectors. Flows through the month, do the rebalance at the end of the month. And then for October, you can kind of see, it's hard to see here because the lines are pretty jumbled in the middle there, but materials and discretionary, you can see they're right next to each other in the legend. They were ones that were relatively close in terms of the relative CAPE ratio. Given the performance in September, that we flipped over and we're in materials and not in the discretionary here so far in October. If we look into the sector rotations, one of the things we like to look at is have we been in every sector? If you look at this since we launched in October 31st of 2013, we've been in every sector other than utilities. Utilities in the sector hasn't been in since any time in 2003. So it's been a long time since utilities has been cheap. You can see that communication services there at the top has been not in the index for a while due to the momentum filter. You can see it kind of moves in cycles though. So we were in communication services for a while, and we've been in real estate here. We've been in financials, and we've been more recently in tech. You can kind of see that we're in and out of state consumer staples, consumer discretionary, and then we're now into materials today. So we are doing, it is some good rotation between the sectors, and it's a case of them moving in waves and really being a way that that the index tries to take advantage of what is cheap out there. So how does this work? This is since we launched our fund on October 31st of 2013. So Halloween 2013 here. So almost 9 years of data. You can see that the CAPE index has outperformed the S&P 500 by, it's called 75 basis points or so per year since inception. The standard deviation or the volatility is very similar, and then you get a higher Sharpe ratio. And really, when you look at this, you can see it and say, okay, it is wiggling and jiggling with the stock market. It is adding some outperformance. Certainly over the past couple of years, performance hasn't been as good as in the previous time periods, but it is going to move in waves, and there's going to be times when it underperforms, time when it outperforms, and we think that over the long term, it's going to continue to add value. Now, if you like this index, if you like this idea, as Ron mentioned earlier, and as those of you that were watching earlier at the beginning of the call, we had that ETF video. There is an ETF with that just invests or tracks or attempts to track this index. It's the CAPE ETF. So if you want more information about that, you can hit us up at etfinfo@doubleline.com. If you like that, if you like just the CAPE index. Those of you that want what we call the double value proposition, let's get into the fixed income side. We think the fixed income is certainly the most attractive it's been probably since we started DoubleLine. Since we started DoubleLine in 2009, and a lot of the fixed income looks as attractive as it's been since the financial crisis. If we look at the underlying fixed income portfolio characteristics, we do run a duration of low duration. So we're not running a 6 or 7 year duration like the Bloomberg Ag. We're running a 1.17 duration. This is as of September 30th. We're running diversified fixed income. So we have a large chunk of the portfolio in government. So that's U.S. Treasuries, about 23% of the portfolio there. Another big chunk is, it's mostly investment grade rated, whether it's in the structured credit side of things or investment grade corporate bonds themselves. But, only 10% of the portfolio is below investment grade. And 11% in unrated securities. If we switch back over to the left, you can see that we are trying to be diversified in that portfolio. We have some floating rate assets in terms of your bank loans and your CLOs. That helps us keep our duration low. The securitized credit also helps, whether it's in the non-agency mortgages, which I pointed out earlier are a good performer so far this year on an index basis, even CMBS and asset-backed securities. And then we have a little bit of EM. We're probably at our lowest EM exposure. We'll get to that in a second. But we can put it together. We can, because we have a large chunk in U.S. governments and treasuries, agency mortgages, or smaller piece, agency CMBS. We have that flight to quality piece in the portfolio. We can take credit risk on the other side of the portfolio. Put all together, we're running about a yield today of almost over 6.5%. Call it 6.75% type yield on the portfolio. And really, when we're looking at it, we're trying to give you that diversified fixed income, try to give you incremental returns over LIBOR or SOFR, given, depending on what it's LIBOR in the past, SOFR going forward, try to outperform that to give incremental returns to our investors. And I almost, as Sam Lau and I like to talk about in our podcast, we always tend to front run ourselves. If we do look at our soil chart here of the fixed income historical allocations over time, you can see that emerging markets is at the top. We're probably at our lowest, or we're at our lowest EM exposure we've been in years. We do have a little bit. We did have a little bit of high yield corporate bonds in 2015, pre-2015. You can see that in that kind of goldish color there in the high yield. But really, we've had no high yield since 2015, and we'd like to continue to keep it that way. We do have that bank loans and CLOs are right beneath it in the gray. Those are your floating rate assets. And then your securitized credits in the middle, your asset backs, your non-agency mortgages, and your CMBS. So really, that's kind of the bulk of the portfolio. You can see there on the lightest blue, that's the U.S. governments. Where it's hard to tell because of the cash numbers there, kind of moving things around a little bit. But we're pretty high in terms of our U.S. government exposure. You can see that it did just jump up there in the September 30th is the end date here. So, in our August asset allocation meeting, one of the things we did was we increased the government exposure by 7%. So that's what a 7% increase looks like in terms of how big that light blue bar got. And we actually took 1% from each of the remaining credit sectors. So go from the top down: EM, bank loans, CLOs, asset backs, non-agency RMBS, CMBS, and investment grade corporates. I'll cut those by 1% each and add that to U.S. governments. Trying to be a little bit more conservative, we think that that yield we're getting on the portfolio of 6.75 is still, after that move, still being a little bit more conservative. Trying to take a little bit of risk off the table and keep a little bit of dry powder for some future volatility that we might get, and a little bit look for some different ways and better opportunities to invest that powder into higher yielding and kind of better looking securities. And so if we'll try to risk manage that the fixed income side of things to not really to not take on too much risk. We know that there's a lot of risk. Do you have that equity risk in the equity side of things and your equity index side of things? So let's not add incremental risk to the fixed income side here in this type of portfolio. So that's why we made that move back there in August, which you can see in September. Now, one of the things that we like to talk about also is, we're not running a longer duration. As I mentioned earlier, we're running 1.17 duration today. It's been that way for years. So we're trying to run a shorter duration portfolio. We call it short to intermediate plus, or short to intermediate duration portfolio. So we're not running a low duration. We're not running a core type portfolio. We're kind of short to intermediate duration. So a 1.2 type duration is right where we want to be. And just wanted to highlight again that the portfolio there, that duration is from its that's pure security selection, pure sector allocation. We're not running any derivatives there, no interest rate swaps or anything to manage that duration. It is solely on the sectors and security side of things. So keeping that duration in line is one of the keys to the portfolio. Now we look at portfolio performance over time. This is only monthly data, so this is not updated month to date. It's only through September. But you can see that the fixed income portfolio has generated returns of 2.1% per year. Compare that to 1 month LIBOR, soon to switch over to overnight SOFR. You're getting 135 basis points of outperformance there from the fixed income portfolio over time. So there's gonna be times like recently where when LIBOR is going up, every day, every month, every quarter, it's harder to outperform LIBOR because your fixed rate, your fixed income side of things isn't resetting as often as LIBOR. Even your floating rate assets are not resetting as quickly as LIBOR is or SOFR. So you're playing catch up, but we think that over time we'll still be able to add some good value going forward from that fixed income side of things. if we do look at it, we say, if you get that 6.75% yield, that's incrementally additive to returns in excess of LIBOR. So really, it's looking like it's a good cheap opportunity, and you get the equity side plus the fixed income side. So if we put it all together, here's where we stand almost 9 years into this fund. The Shiller Enhanced CAPE has outperformed the net of fees and expenses, so net of everything, by 24 basis points per annum, to the S&P 500. Similar risk, higher, similar Sharpe ratio. We do think that, certainly if you look at the gap between the blue line and the dark gray line, that has come in a lot over the past couple of years. A lot of that is just due to the fact that there's been nowhere to hide in the fixed income market, so that fixed income returns have not been great. But we think, that's, we always like to say that's in the past. Let's look forward. Let's look and see what's the yield of the portfolio. We have a high yield, low duration, where I think that's poised to add some incremental performance over time. So you'll get the CAPE index plus that incremental fixed income return. If we switch over to the Shiller Enhanced International CAPE, so same idea. So I won't go over the structure or the process, but it's the same idea. We're going to take the Shiller European CAPE index, add the fixed income underneath, and you deliver to investors that double value proposition. Here's a chart we've been using recently where we look at the S&P 500 ratio to the MSCI Europe. And over the past, call it 2.5 years or so, that ratio has kind of bounced around a little bit, but hasn't really moved too much outside of that band. And really, when we look at it, we think that, or let's talk about when that ratio is moving up, that's the S&P outperforming Europe. And when the ratio is moving down, that's the Europe outperforming the S&P. So it has outperformed, recently with a lot of volatility. But really, when we look at it, we can think that it could be a good time to move into Europe and out of the S&P 500, given that it's at such elevated levels. This is like a 5-year chart. We'll get into a longer term chart later. But if we do look at the 12-month forward price to earnings, so this isn't the CAPE. This is just the normal PE ratio. The red is the S&P, and then the red dash is the median S&P. So you can see that for the S&P 500, the forward-looking PE is higher than its average. You look at Europe, the forward-looking PE is well below its average over this time period, over this kind of 17 years or so. And so using that, it looks like Europe is cheap. A lot of that is likely due to the fact that there's a lot of talk, there's a lot of ideas out there that Europe is, if the U.S. is 100% or not 100% going into recession, then Europe certainly is 100% going into recession. There's a lot of that, certainly a lot of that's going to depend on energy and how energy works out over there in Europe, how the weather works out. But people are pricing in kind of almost a worst case scenario for Europe. And that's the time you want to buy, right? You want to buy when people are pessimistic and sell when people are optimistic. And so you can look at the PE ratio or the PE ratio here and say, the PE ratio is cheap. It may get cheaper, maybe cheap and getting cheaper, but certainly you can look at this and say your forward expected returns will be higher in Europe versus the US. And one of the interesting things to look at is the sector composition between the S&P and S&P 500 in the US and in Europe, and how, this is one of the times when you look at the colors in the pie charts, and it's helpful because you have your lighter blues make up a much larger chunk of the Europe sector composition than they do in the US. In the US, you have energy, utilities, real estate, materials make up such a small piece of the pie, whereas your four smallest sectors in Europe make up a larger piece of the pie. And you don't have a large 26% to technology. Your largest weight there is in healthcare at 16%. So it's much more diversified. And so if you're thinking about wanting to get into a more diversified index or more diversified index or economy, that Europe is a way to look at it, and you get some diversification to your U.S. sector allocation. So just an interesting point there, but it could provide you a little bit more diversification benefits. And if you look at the dollar, certainly the dollar's been a talk of the town here, as you've seen it bounce off of that call it 89, 90-ish level, hit a 114 level, it's down to back. We can call it, last night 111.999. I think we can safely call that 112. So it's bounced off its highs, and usually when you do see, usually a weaker dollar is bullish for U.S. investors investing in Europe. So when that dollar index, and this is the Dixie dollar index, so it's like 60% euro, 12% pound, and then an 8% in combination of Sweden and Switzerland. So it's very heavy in Europe. That it, or let's call it the European. Yeah, let's just call it Europe. That when this comes back down, it should be pretty bullish for the U.S. for U.S. investors in investing in European markets. So something to keep an eye on here. If that dollar continues to weaken, that should be helpful for U.S. investors investing overseas. And then here, finally, let's get to the CAPE ratio. So, the red line is the U.S. CAPE ratio. So it should look very familiar because we just showed it earlier today. The blue line is the European CAPE ratio. So look at pre-financial crisis, they were very, very similar. They kind of moved together, bottomed out together. And then you can see post-financial crisis, the U.S. CAPE ratio has taken off. And Europe has has lagged a lot. And we don't have the averages on here, but you can kind of see, looking at it, kind of eyeball it. It looks like maybe the European CAPE ratio is actually below its average over this time period. And so when you look at that, maybe now is the time to, again, not using this as a in or out tool, but saying, okay, maybe it's now time to maybe diversify a little bit more into Europe. Europe looks cheap on a CAPE ratio basis. Maybe it's time to actively rotate some of my U.S. equity exposure into Europe, be diversified, try to take advantage of that opportunity. And then we have a much longer term chart here. I'm not going to touch on this, but you can see this is the kind of the inverse of the chart we showed earlier, where it's the Europe on the top of the ratio, S&P 500 on the bottom. So when that number is going up, that Europe is outperforming, and you can see how much outperformance the S&P 500 has done versus Europe. So again, could be a good time to move into the European equity market. So let's shift our focus again to the Shiller Barclays CAPE Europe sector, net index rules. Very similar, only that in Europe there's only 10 sectors. There's not 11. So you have the 10 European sectors. Choose the 5 cheapest. Kick out the one with the worst momentum. You have the 4. Equally weight those and do that every month. Now, one thing to point out is that because the euro hasn't been around for 30 years, we're using 286 years in an expanding window. So when we get to 360 years or 30 years of data, then it will be a rolling window. But until we get then, it's just an expanding window using all the available data. But the same idea as the US CAPE, just doing it in Europe. And here you can see the relative CAPE ratio across the European sectors. You don't have that huge, energy here is high. I would expect it to be higher, just given all the talk and all the talk about how energy and how expensive energy is. But maybe it's the price cap talk that's keeping the cap on the relative CAPE ratio there in energy. But it's much more jumbled up in terms of relative CAPE ratio. But the same idea here, where you have discretionary staples, communication services, industrials, and then financials plus real estate all jumbled together as your 5 cheapest. And so then you choose the 4 and kick out the one with the worst momentum, which in this case, you can look and see that black line is discretionary. So that's been kicked out, and then invest in those 4 other sectors. So same idea. This one only goes back to 2008. We launched our fund in December of 2016. So since we launched in December 2016, we've been in every sector except for technology. We've been in all the other sectors. And you can kind of see that it is still having that same idea, where it was in utilities for a while and hasn't been in utilities since. It's in and out of staples a lot of times, discretionary, been in and out. So it has the same sector rotation idea that is in the US CAPE. If we look at the performance, so this is since we launched our fund on December 23rd of 2016, the Shiller Barclays CAPE Europe sector, net index, so let's call it the CAPE Europe index, has outperformed the MSCI Europe index by 174 basis points per year. Actually, has lower standard deviation. Obviously, that leads to a higher Sharpe ratio. But look at that. You can see that up until like 2020, it was kind of they were kind of fighting which one was going to outperform, which one was going to underperform. And then we had some pretty good outperformance there in 2020 and so far this year. Let's not jinx that. And so it has been performing very well using that sector rotation idea. Combine that versus with the fixed income portfolio. This chart should look, these two charts should look very familiar. It's a different portfolio, but same idea. 25% governments, your CLOs, similar type yield, and similar type credit rating. So we won't get into that. We covered that already. And then this is the same soil chart, or same idea of a soil chart, much shorter time frame, a little bit compressed in terms of your sectors. Same idea. We did increase governments here by 7%, and diversify and cut the credit risk. So same idea, same asset allocation committee, same portfolio managers as the as in the U.S. CAPE index or the U.S. CAPE fund, and similar chart here with the historical duration. This one's running a little bit longer, 1.25 versus 1.17 on the Shiller Enhanced CAPE index or Shiller Enhanced CAPE fund, but similar idea, similar strategy. We look at this much shorter. We were missing that 2013, 2014, 2015, and most of 2016 data. So looks a little more magnified here, but we're still outperforming LIBOR by 40 basis points here on an annualized basis. Positive Sharpe ratio. Obviously, we do show, and I didn't talk about it on the DSEEKS one, but we do show the 1 to 3 year U.S. Ag just to show you kind of what is the bond market doing? What's the short duration bond market doing? Nowhere to hide, as I talked about earlier. Look at that 1 to 3 year aggregate index going back down, kind of at that 1.05 type level. So we're still outperforming the general short duration bond market. We're outperforming LIBOR. We're adding incremental returns to the portfolio. And here, so here we go. Here's put it all together again on DSU, as we call it. It's a 4% return, 401 return, 348 for the index. So you're outperforming by 53 basis points. We're coming up almost on 6 years now. Some pretty good outperformance overall from the portfolio. Similar standard deviation, and a similar Sharpe ratio, or and a better Sharpe ratio. And we do go over this. We do have, these are two of our longest running smart beta, or these are our two longest running smart beta portfolios. We like the double value proposition there. We like both the U.S. CAPE index and the European CAPE index. If we kind of go through, we have a couple takeaways here, or a couple takeaways before I get into questions here. If we do look at it, we look at the U.S. market. The U.S. markets, just to kind of summarize, I have them listed as A, B, and C. So A, the U.S. market is trading closer to its average historical CAPE ratio than it has been in years. Full returns should be expected to be better than any time since 2016. So that that's making the case. Okay, we kind of rode this down market here so far this year in the stock market. Things should be looking better, much more rosy going forward. B, the European market is even cheaper than the U.S. market. Overall pessimism, regarding Europe has been weighing on their equity prices. Could be a good time to move into the European equity market. Could be a good time to diversify out of the U.S. Really, or just add some diversification across the globe in the U.S. And then C, for both portfolios, the fixed income portfolios are positioned very well to take advantage of the opportunities in the fixed income market. We think that the fixed income market overall is one of the cheapest it's been in years, probably since the financial crisis. Outside of that kind of COVID blip that was pretty uninvestable. We think that the fixed income market is poised to add incremental returns above and beyond that we've had, that we're experiencing in kind of the low volatility environment, and that we think that over time we'll be able to add much more value in the fixed income market. If we do look at Fed funds futures here. As I showed earlier, we got 150 basis points priced in. We're already 300 basis points in. So, you can look at it and say that we're kind of, we're closer to the end than we are at the beginning, because we're, if we're going to get to 5% Fed funds rate, certainly we're closer now than we were at the beginning of the year. And that a lot of this is already priced into the market, right? So that's what's the important part, is what's priced into the market, what's market expectations going forward. So if we do get 150 basis points, we should, obviously the market's not going to be unchanged. Markets move every second, but that's already priced in the market. So we should be able to see some good opportunities going forward, given that that's what's priced into the market. So we think that the economy offers good double value propositions for both the U.S., the Shiller Enhanced CAPE, and the Shiller Enhanced International CAPE. And with that, let me look and see if we have any questions here. All right, we got some questions. Let's see. Let's start at the top. Let's see. Let me see if I can pop this out here. There we go. All right, this is much easier. If we do look at, one of the questions is, if we look under the hood, under DSEAGS, kind of why has it been lagging the S&P 500 over the past couple of years? Certainly this year, and this is a mahalo Paul. So mahalo Paul. Certainly this year the fixed income side has been hurt, given the fact that we've been that the fixed income side there's been nowhere to hide in fixed income. You've had that huge run up in both short-term and long-term interest rates. So it wasn't like you could, usually when people think that interest rates are rising, that you can hide in short duration, but just given the huge move in the 2-year, you really couldn't even hide in the short-term rates there. So a lot of that underperformance has been because of the fixed income side. But again, we're kind of poised to see that doing well going forward, just offering that incremental yield. Let's see, we have a question from Stephen about the multi-asset trend. Stephen, we'll get back to you on that on email. Let's see. Do we think that historically the Fed has overshot when it comes to terminal Fed funds rate? What do you think is an appropriate terminal rate this cycle? Yeah, I think that, if you look at the Fed funds rate increases and recessions, the Fed hikes till you get to a recession, and then they cut. One of the things that maybe gives us a little bit of hope is that the Fed is starting to talk about kind of tapering their rate hikes. So they're doing 75 here in November. We'll do 50 in December. They kind of taper back down to a 25 basis point hike in February. If that one comes to fruition or not, who knows? But really, when you get if they start to taper, they pause and they wait to see. They know that the Fed funds react with they call it long and variable lag in terms of its effect on the fixed income or its effect on inflation. So when they look at that, hopefully they're looking at that and saying, let's see what we've raised. At that point they'll have raised 450 basis points. Let's kind of see how that shakes out in the market. And if they do that, then I think that they have a much higher, there's a much higher probability of them being able to engineer a soft, or, Chair Powell has kind of made it a softish landing. Certainly, if they can engineer that softish landing, then it's going to be on the back of the fact that they paused and didn't continue hiking going into a recession like they've done every other time. So part of me is hopeful because they are starting to talk about reducing the slowing their rate hikes. But historically, you look at it and they're going to hike into the teeth of a recession, and then they're going to cut. So whether you believe this is the new Fed, and part of it is Chair Powell is not a economist by nature. So maybe he's looking at things a little bit differently, and that gives me some hope that they're not going to just hike into the middle of a recession. Let's see, who's going to buy all the bonds that the Treasury will have to issue over future decades? I mean, that's a good question. I think certainly people will be, if we're at 4, let's see what we are right now. We're looking at the 10-year. We're 410 on the 10-year. It's going to be interesting to see. Like, that's a pretty attractive yield, certainly versus where we've been in over the recent past. Certainly where versus where Japanese 10-year bonds are. And so you have three big buyers. You have the Fed. You have or the Fed is a much big buyer these days than has been in the past. You have foreign central banks, and then you have kind of private issuers, bond managers, or pension funds. And so I think that you could see that if you get to a high enough interest rate level, that pension funds will kind of move in and could be a big buyer of treasuries. Their goal isn't really total return, right? Their goal is to kind of manage that asset liability mismatch, or the asset liability. And if they can get higher yields on their treasuries, then you could see them kind of move in and cut their equity allocations and buy their treasury allocations. It's all about what the yield is. So whether if the Treasury is issuing so many bonds that the yields are going higher, someone will step in eventually. Let's see. Someone asked, how do you factor the war/nuclear risk for Europe, especially Germany? And I think that I don't know how to answer that question, but it just reminds me of the story about how Jeff Sherman and Professor Shiller were doing an event, and they kind of have prepped everything for, we're going to talk about, what worries you, and whether it's the housing market or and kind of what worries you in markets overall. And Jeff Sherman asked Professor Shiller, what bothers you? And Professor Shiller said, nuclear war. And it's like, well, certainly that's at the back of everyone's mind. That's one of those things that is always out there. I think that, if there is that nuclear war, it's really going to be, if it stays over in Europe, that would be, certainly the U.S. markets would be affected by that, and the European markets also. But I think that, at that point in time, maybe there's bigger problems to worry about than our portfolios. And let's see, there's another question about Morningstar data. I don't look at Morningstar data, so someone will get back to you on the Morningstar data. And then let's see, we're coming up almost on an hour here, and someone asked, what does the mustache mean for the economy? And I'll say that the mustache is because I'm, for my Halloween costume this weekend, I'm going as Luigi. My little daughter is going as Princess Daisy. I almost said Princess Peach because I was thinking Princess Peach and Mario, but Princess Daisy. So that's what the mustache is for. Hopefully everyone has a good Halloween. Stay safe over the weekend and certainly on Monday. And with that, I'd like to thank everyone for tuning in, and let's hope that we can end the year on a strong basis, and take advantage of the opportunities that we kind of see in the fixed income and equity markets.